Here at Trade School for today is the 29th of November. And let's see what we're going to talk about today. Not going to talk about that stuff. We're going to be talking about determining exits. So this was based on a request yesterday in the Discord room. A lot of people were saying, hey, look, when you enter a position, how do you determine, first of all, what your stop loss is down here? Where's your exit? And then also, where's your profitable target that's above the price? How do you put those together? So I took some time to put together what I think is a pretty detailed example. Hello, folks. Welcome aboard. Good to see you guys out there. So what I would recommend that you do, and as I went through this example, building this example, what I think I'm going to do is I'm going to append this session today, this trade school session, onto a couple of the classes that we've done, such as the short-term strategies would probably be a good example class to append this onto, because from what I'm understanding here, a lot of people are having trouble. And as I went through the math, I can see why people are having difficulty with this whole concept. Hey, what's everybody doing out there? Good to see you guys. All right, so without further ado, let's dig into things here. A lot of you have taken to heart rule number 1 of risk management. So I've been pounding on the desk about this stuff for a long time, right? So don't enter a position before you define your exits first, or something to that effect, right? I've been saying that same thing for quite some time, and it's starting to take hold. People are starting to think about it first before they enter. And this is going against every impulse in your body. Just like when you see something running, you just want to jump on board and wait a minute, time out. We have to define our exits first. Okay, so I know that this is difficult because it goes against what you want to do. You want to just, assume that everything's going to work out for you and get on board because the train's leaving the station, and, why is Doc telling us to slow down? And, we're going to miss out on this trade if we don't get on board it right now. And this is why you have to do this sort of stuff. Okay, so if you can just manage to accomplish this one little task, no matter how inconvenient that it is, you're going to put yourself heads and shoulders above 99% of the other retail investors. I keep saying this, and I do firmly believe it because I see this everywhere, is that, oh, dude, I got wrecked on that trade. Nobody should be getting wrecked on any one individual trade. And that's what we want to stop here. Trading is not about, just shaking the dice and gambling and going all in on these things, backing up the truck and things like that. It's not about that. Investing is very much a calculated risk, taking a calculated risk that you believe that you have an edge in. That's what it's all about. So we have 2 decisions to make: stops and profitable exits. The price could go up to a profitable exit, or the price could go down and maybe we need to get out of it. So in this case, like if you're looking at a setup like this and you say, well, okay, I see the price breaking out here. I need to define what my stop is, and I need to define what my target is. Now, how do you go about doing that? Well, a lot of you might just say, just arbitrarily, you might say, okay, well, I'm going to put my stop down here because if the price breaks down below there, then that's a lower high, lower low. And that may be one way of doing it. Certainly is, but you're not really quantifying what your risk is. And then a lot of people have no idea where to set the target. Perhaps they're going to go, well, I'll just wait till it starts turning down. Well, will you be there at that very moment when it starts turning down? And what does it mean to turn down? Is turning down doing something like that? And what if it does this? What are you going to do? A lot of that decision depends on what type of strategy that you're trading, doesn't it? Okay. So let's work on stops first. Where do we place the stop? Where do we look for the target? So when it comes to stops, there's 2 different ways that we can set up the stop. One is the active stop, where you're actively managing the position stop loss through your broker. And the other way is through what I call a fixed risk position. So let's say that we have a $5,000 account. And for those of you that are not using the dollar as your fiat currency, just substitute, for 5,000 euros or whatever you want to use in there. It really doesn't matter. So $5,000 account, 2% risk on that account will be $100. Okay, hopefully everybody's with me. So far, 2% times 0.02 times 5,000 is 100. How can we fix our risk on this trade to $100? How can we limit our risk on this? The most that we can lose on our account on this one trade is $100. As I'm doing this example, so I was writing this up, the price of this coin that we're going to use, and I believe this is Worldwide Asset Exchange, WAX, whatever it is, doesn't really matter. You can use any coin for this example. And I would encourage you to go out there and try to experiment with this and work your math backwards and forwards and make sure that it's correct. So as I'm doing this, the price of this coin is currently 1, 2, 3, 4 zeros, 0.0000017 BTC. So that is actually, I believe, unless somebody wants to correct me, I believe that is 1,700 Satoshis. BTC by itself, as it's trading against the US dollar, is 42.90. Again, this was this morning when I took up this example. Okay. All right, so those are our two data points with this. How big of a position would translate to $100 or 2% of our account? So what I'm going to go over initially is the fixed risk position, where I can say, look, the most I can lose is if this coin goes down from 0.00017 down to 0, if it gets totally delisted and ceases to live as a coin, right? That could happen. So how can I set my risk on this so the most I'm going to lose on this, no matter what happens, is 2% of my account or $100? How many BTC should we reference against this to set the entire position size to 2% of our account? So I'm going to show you a couple of different methods, and I encourage you guys to work through these examples, or if there's a different way that you do it, which comes up with the same answer, then awesome. It doesn't really matter, right? So pick the way that makes sense to you. And what I will also say is that it may not, as you listen to me live, these may not make sense. The first time you walk through this, you're like, what did you do there? So I encourage you to rewind, playback, go through a couple of examples until this stuff is near and dear to your heart so that you can work these things back and forwards. None of this is all that difficult. This is all 7th grade algebra. Okay, so method number one, what I'm going to do to begin with is I'm going to convert this to fiat currency. Now, you can also do this if you go to coinmarketcap.com, or you can check your math with coinmarketcap.com. So that's exactly what I did. I went over to coinmarketcap.com and I said, let's make sure that I'm not telling a lie here. And it was somewhere in the vicinity of 7.3 cents. So if I take the price of Bitcoin, right, times the price of, on the chart of what it was showing 0.00017 BTC. That is about 7.3 cents per coin. Okay, so I'm going to convert it over to fiat first. And some of you are going to be more comfortable just working in dollar terms. I know I certainly am. Just, it comes with the territory. We just do what's familiar to us. It's kind of like when somebody in the United States says, oh, that's just, 6 kilometers down the road. You're internally converting that. Okay, so that's about 3.6 miles. Okay, now I understand a reference for it. I don't really have a reference in terms of what kilometers are. Yes, we are quite backwards in some ways here in the States. Okay, so 7.3 cents per coin is what this particular token is going for right now. So if I say here's my $100 that I've got to work with on this trade. And if I divide that by 0.0729, that's dollars per coin or dollars per token, I get an answer of 1371. So that is my bottom line result here, is that if I want to risk $100 of my account, I'm going to purchase 1,371 tokens of WAX versus BTC. So again, I'm going to have to transfer some Bitcoin over to my brokerage account to be able to buy this, right? Because I can't do this through USD, but I'm converting to fiat just to determine the answer for what is 2%, and that 2% value is 1371 tokens. A 1371 token position will limit our risk to 2% of our $5,000 account. Okay? Everybody with me so far? That's the fiat way to do it. That's not the only way to do it. Method number 2 is we can normalize everything to BTC. This is probably how we should be doing it. We should be thinking in terms of the reference currency that we're going to be trading in. So since my reference account is in US dollars, what I'm going to do is immediately convert that over to BTC. So $100 of risk in BTC at today's prices. So I'm doing a currency conversion here. 100 divided by 42.90 is 0.0233 BTC. So 0.0233 BTC is worth $100. That's my risk figure. So I have to limit my risk to 0.0233 BTC. Now, if we divide this 0.0233 BTC, this is my risk, and here's the price per coin divided by 0.000012347 is 1371 tokens. I get the same answer. Yay. So again, here, the same thing. A 1371 token position will limit our risk to 2% of our $5,000 account. So you can do this either way that makes sense to you. I would encourage you guys to work this back and forth so that you can come up with the same numbers, or do some other examples of your own to make sure that you get this. So if we want to fix our risk at the very beginning of the trade, this is what I call a fixed risk position. And this is mostly what I do with most of the trades that I do in the newsletter or anything else that I do, because I don't want to care about this. I want to keep the position size small, and I want to encourage you guys to trade small so that you don't become emotional about this. There's so many emails that I get like, oh, I'm sorry, I put way too much of a position into this one coin and it's dropping now. What should I do? I'm like, you know, let's fix the problem first. The root issue here is that rule number 1, you didn't follow rule number 1, right? So this is usually where I'm left with. It's like, okay, this is a teachable moment. Let's go back. Let's make sure we don't do this again. So this is why I'm very much a believer in this type of trade, and just about everything that I do across investing, everything is limited risk trading. I never get involved in a trade where I don't know my risk to the penny. And if there's one thing that you'll find if you talk to any professional that's out there, every professional will know their risk to the penny, not only on every trade, but also to their entire account of what's involved right now. You know, anything that you have in your portfolio, you'll know the entire risk, what could happen if everything dumps, because capital is your lifeblood. If you run out of capital, you're done. You're become a greeter at Walmart, or you have to enter the job force again or something, right? So that is just not an option for me. I have to know this. And I encourage you guys to do the same thing too. So again, if we want to fix our risk at the very beginning of the trade such that we don't really care what happens to it, use that 1371 token size. We'll never, ever lose more than 2% of our original account, even if the coin goes to zero. The other benefit of doing this is that what you'll find is that you're almost, I won't say uninterested participant, but you certainly, there's that lack of adrenaline in the trade. it just becomes sort of a business-like thing. You're like, oh, yeah, it's 2%. Did it go up or down? I don't know. I wasn't paying attention. And when you don't care about the outcome of trade, then and only then is that when you can effectively manage that trade. If you care too much about the outcome of that trade, you're going to be watching your block folio every 5 minutes and you're going to be going nuts watching the thing. And usually that's when your subconscious mind will kick in and enforce the wrong decision in your trading. Okay, so any questions before I go on here about fixed risk positions? So I'm a big believer in them. So how do we set an active stop? Let's talk about an active stop for a minute. An active stop is where we actually set up a stop order in with our broker. We'll set that good till cancel in there. It's the opposite trade to our entry. So as soon as we enter, well, some brokers are easier than others at this. So what I found is that most crypto brokers are really, really bad at this sort of thing, is that you can't just click on an existing order and say, set a stop, which I can do in a lot of other equity-based brokers. I can just right-click on it and say, okay, I want to set up my stop loss, and then here it is. Boom. But in a lot of crypto brokers, you actually have to enter an opposite order, and it's somewhat cumbersome. Again, another vote against the active stop, but I realize why some people want to do this. One of the reasons why people want to use an active stop is they say, well, look, Doc, 2% of risk, that sounds great on a risk management, but man, if I hit a home run, I've just got this little itty bitty position that's going from 2% to maybe it's, maybe I've grown it another couple of percent in my account. Maybe I got 100% return on that. Now I've only added 2% of capital to my entire account. I really believe in this trade, and I think this is going to be a home run, and so I'd like to put a little bit more capital into it. Okay, you can do that. I would not overdo it. In other words, never put your entire account into the position. I would say a good rule of thumb is I would not put more than 10% of your capital into one position. But even if you put 10% of your capital into position, you still have got to manage the risk to 2%. And that can put you into kind of a bad place, because the more capital that you use on the position, yet you're still trying to limit the risk to 2%, your stop loss is going to be really close and you're going to get taken out. You're not going to be happy with the results of it. So again, keep your trades small. That's one overall guiding principle here. So, all right. Hopping off the platform, off my soapbox here, let's say that we used 5% of our capital to enter this position. Without an active stop loss, we could potentially lose up to 5%, right? If we entered that, it could go diving down to zero. Our position goes dumpster diving, and next thing you know, it's delisted, it's worth nothing. And we've just broken rule number 2 of risk management, which is risk no more than 2% on any one position. That is the golden rule of risk management. Okay, no bueno. Okay, so let's do the math here. 5% of our account, and if anybody doesn't get what I'm doing here, 5% of our account is $250. Okay, hopefully that is not 5% of our account, which is a $5,000 account. 5 times 5, 25, $250. So $250 of risk in BTC. So the entire position is risking 0.0583 BTC. That is 5% of my account. But remember, we need to limit the risk to 1371 tokens. That hasn't changed. Remember from the earlier example, that risk of 2% is 1371 tokens. So this entire position that we're putting in is 3,428, but we need to limit the risk to 1371. We need an active stop here. We need to have something. We need an overwatch to make sure that we don't risk too much on this, because a 5% haircut on one trade will hurt. So here's our little chart again. Where do we put the stop here? Now, a lot of people are tempted to say, well, clearly you should put the stop, and you can pick any number of things here. Clearly you should put the stop down here, or clearly you should put the stop here or down here, or look, you can pick any technical level for that. The tighter that you are, the less tolerance that you have for volatility. And each of these has their own certain, so you can set a technical stop, but then you're going to have to work backwards on the numbers. So I'm going to leave that as an exercise for the viewer, that if you want to set a technical stop, you're going to have to work backwards to determine what your maximum position size is for that, so that you can limit your risk to 2% or less for that. So this is what we have to do. We have to figure out where we're going to put our stop here based on the numbers, not on the chart. So what is the risk again? So $100 of risk is 0.0233 BTC, which is the same as the first example, right? The fixed risk position was risking 0.0233 BTC. So what price level on the chart corresponds to a loss of 0.0233 BTC for this position? So guys, I'm going to reiterate, if doing this through words alone is not going to cut it, if I was listening on the other end of this, my eyeballs will be rolling back into my forehead like, oh, I don't get it. I don't see what he's saying, because I'm one of those people that I need to work through it myself to learn it. I can't just watch somebody do it. So if you're one of those people that, what's the word for that, experiential learner that has to do something with their own hands to learn it, I feel for you. So what I'd recommend is that you go through, copy down the numbers, and then work backwards and see if you can come up with the same thing. Okay, so our starting position, remember, was 0.0583 BTC. That's our 5% position. Now, our risk on the trade is, if we subtract 2% of the risk on the trade, this is what we're going to have left. And that's where we need to set the stop. Excuse me. So we're going to go back to ratios now. We're going to go back to ratios, and this is how I do a lot of things. So if I look at this, what do we know right now? Let's put down all the variables that we know. We know what our starting position size, and we know what our starting position price is. So this is the value divided by the price. Now we know what the value is of the stop value. We saw that on the previous slide. The stop value, what we have left of this, that's our value. We know that now. We've already just calculated that with the previous slide. What we don't know is what's the price for the stop. We have no idea what this is, okay? So for those of you that don't know how to do this, what you're going to do is you're going to multiply. You're going to do cross multiplication. All right, and I'm actually going to draw this out. And so what we're going to do is, let's use the smaller font here. Let's use the smaller font. So we're going to go 17 times 0.035 equals 0.0583 times X. Okay, so we're going to multiply these two together. We're going to come up with some kind of a product. And for those of you that don't know, what we're going to do is we're going to divide both sides by this 0.0583. So eventually what we're going to see is the 0.0583 over here. We're going to cross this out because we substituted, right? So X equals the product divided by 0.053. And if we solve for X, what we're going to get is 0.102. So remember, the original price when we entered was 17, and it's going to be 10.2 down here. Okay? Does everybody understand that? Does everybody understand that? All right, so I'll pause here for just a second here. Again, what we're doing is we're doing ratios. Value divided by price. We know what the value is of the stop position. We know that if we lose 2% of our 5%, if we've only got 3% of that position value left, we already know what that is. We know this. We can calculate this. What we don't know is we don't know what the price is in BTC for that coin when it's down to there. So we have to solve for that. That's the only thing that we don't know. And if we solve for X, this is the value that we're going to get. Algebra 101. Yeah. Someday when we were going through algebra, when we were in class in 7th or 8th grade or 9th grade or whatever it was, we're like, ugh, this is so stupid. Why are we doing this? Why are we factoring the equation? This is so ridiculous. I'm never going to use this in my life. And here it is, 10 years later, right? Here we are doing it. Okay. So, again, what I recommend, guys, is that if you don't get this, if this is just going right over your head, like, I don't get this, you've got to sit down with the same exact example and work through this until you get the same answers that I do. Don't be afraid. Don't be afraid. Okay, so here's where we would set the active stop. So our position was being entered right here at point or 1, 2, 3, 4, 1700 Satoshis, and our stop is going to be down here at point 1, 2, 3, 4 zeros 102. So down here, that's where we're going to put our stop loss. Now, some people may look at the chart and say, well, that's ridiculous. Why should you lose all that? Why don't you put your stop up there? Well, you can if you want to. Make sure it's not too tight. Make sure it's not too tight, because a lot of times this is a very obvious place to do a stop run. You can see how many times has this already been run? 1, 2, 3 times already. And notice that the price was like up here and comes all the way down here to do a stop run, because that's an obvious place to put a stop, and then boom, it's all the way back up again. So this is one very, very common thing for retail traders to do, is to focus on not losing any money. Well, if I lose money, I don't want to lose that much. I just want to lose this much. And so you end up losing that much because you're not willing to, you haven't let go of the risk of the trade. So this is one way to do this. This is an active stop. This is how to set an active stop. This is how to calculate it. Yeah, all these years. Now, I will say that I had to take differential equations when I was in college, and I struggled with that. That was one of the, I think that was one of the 2 Ds that I got in my degree. I can't say to this day that I did not understand it when I was taking it. I tried, it's just right over my head. And to this day, I will, differential equations is just not something. Now, calculus is actually something that we see all the time, believe it or not. At the time, that didn't make any sense to me, but we do use that quite a bit now. Now let's flip around in the opposite direction. Instead of working on the stop, I hope everybody got that, or at least is going to dedicate themselves to taking the time to get that. Now we're going to set targets, and I'm going to be a lot looser about this. I was very rigid about setting stops about 2%, 2% or less. Don't forget that 2% is the maximum figure. You can't set these for less than 2%. I'm going to be a little bit more loose in terms of setting targets, and I'm going to push back and say, well, this is what you need to figure out. And I'll show you a few different methods for setting targets. And I want you to pick one that makes sense to you. Isn't that that's very nice of me, isn't it? Okay, so a lot of different ways to set targets. You can set a fixed target gain like 10%, and this is what I brought up in the short-term trading strategy class, is like, look, start small, just go for that little 10% gain. It's not a home run, but 10% will make you puff out your chest and say, man, I just won 10%. That's awesome. Okay. If you want to be a little bit more elegant about it, go for things like the average swing length. This is kind of what I've been looking at lately more, is an average swing length, because you don't know if that swing is going to be good enough for 10%, and especially in a bear market. So I'm going for what the market is giving us in terms of the character. And I'll explain an example of this in just a second. Average swing length. A dynamic value like signal exhaustion. If you have signal chart exhaustion, so let's say you're using a daily chart as your signal chart. If it's exhausted, guess what? It's going to consolidate. It's going to sit there and pull back or flag out. It's going to frustrate you. Why not just sell into strength? If you have an exhaustion signal, that means that you've had range expansion. You're sitting on a profit. Perhaps it's time to take profits in that. Upper Bollinger Band is another way to take profits on these, because a price hitting the upper Bollinger Band generally has gone for 2 standard deviations, or another way to put that is a little bit too far, a little bit too fast. So it's gone from range contraction to range expansion. Sell into strength. That's okay. You can use a trailing stop like in the trend trading strategy. For those of you that went through that class, what we're looking for is an N-day breakdown. So what we're doing is we're following the price up with an envelope that's following an N-day breakdown. So an N-day breakdown, in this case, maybe like it's a 10-day breakdown. So this is of the last 10 days. This is the lowest price was up here. There's an N-day breakdown. And oh, now we have a price that's up here. And so eventually what's going to happen is the price will, after it stops and starts getting weak, will break down through that lower Donchian. Again, that's all explained in the trend trading class. The shorter duration trades, if you're doing swing trades, if you're doing intraday stuff, you should be more aggressive about getting getting your fair share, and getting out. Sell into strength, which is going to feel weird, right? So a lot of you see the big move coming, so we see range contraction, then we see the breakout, and we take the breakout, and we see the big breakout like this, and we go like, oh, this is awesome. I love this. I'm going to hold on to this thing forever. And then all of a sudden it starts giving it back. And then it even comes down to retest that breakout. And all of a sudden you're scrambling to get out for break even. Not again. Right? The market has a way of finding out what people want. And it will usually find your pain point. So if you're a short-term trader, don't be afraid of selling into strength. Get your fair share and get out. That's all you're trying to do. All of a sudden, you've changed your mind. You've changed your approach mid-stride in the trade. Before, you'd be happy to take a 10%, and all of a sudden you get greedy because all of a sudden it's, oh, look at the thing go. It's going to go to the moon. I've decided I'm going to hold onto this trade. And then all of a sudden, if the price comes down again, you're going to change your mind once again. Don't change your strategy midstream. Determine that before, remember rule number 1, determine it before you enter the trade. Where am I going to get out of this thing? Sell into strength. There's no shame in taking early profits if that is what you're there to do. The longer duration trades, you're there to squeeze as much as you can out of that trend. That's the whole purpose of it. It's got a much different function. You're trying to get on to one of these massive trends and ride that thing off into the sunset. So you got to give it a lot of room. You have to have much more lenient exits, but you've got to use those end-day breakdowns and trust them and not say, oh, I saw a breakdown today, but I'm going to stay in it because I still feel like it. No, don't do that. Here is an example of an average swing. So as we start to see in this case is chain links, start to pop off into these, consolidation, builds up a lot of energy, and then boom, breakout. How far did it go? Okay, well, let's measure it. And let's actually use a trend line and let's keep it on here. All right, so if we look at the next swing, all right, we were a little early on the next swing. It didn't go anywhere for a while, but eventually it topped out right around the average swing length. Okay, yay. Here comes the next breakout. It goes to about the average swing length, and then the next break is about the average swing length again. And I could do this again on this one as well too, even though it's now in a primary, or at least it's beginning a primary downtrend, so I don't trust it right now. Somebody was asking me in the Discord room, like, why aren't you in this one? And I'm like, dude, we've been talking about this for months now, right? So that is the average swing length. And it's right now, I think if you're able to read a chart, if you're not intimidated by charts and kind of determining what an average swing length is, it's okay to sell into these things. You don't have to hold through the next consolidation. So determine your stop, active or fixed risk. Pick one, don't pick both of them, depending on your style and your preference. This needs to be very rigid. Stick with one method. Stops, got to be rigid with them. Exits, you can be a little bit more lenient, not lenient, but you can be a little bit more subjective in terms of your targets for the trade. But stick to it. If you determine an exit at the beginning of the trade, stick to it by the end of the trade. Don't change your mind. The exits will very much depend on what your strategy is. Notice that we talked about different exits for trend trading versus short-term swings. Okay. I hope this helps. I've tried to be very targeted with today's presentation because I kind of see where people are getting confused with this. And again, like I said, going through the example today, this is not easy because it's like, wait a minute, wait. You can get very mixed up in the numbers and mixed up in the ratios. And it's something that, I was talking to Mav today, and it's like, coming up with all kinds of ideas like, hey man, we need to have an app for ReadySetCrypto, and this would be a page, this would be an app in there where you could just like plug in there and the Satoshis for the coin and your balance and your risk and everything, and it would tell you exactly where your stop is going to be. It's like, yeah, let's do that. So a lot of ideas that are out there, somewhere down the road. But what I would do is I would go through a couple of examples here. Make sure that you understand, get it. It's like you're not going to understand this just hearing me explain this to you unless you're a very unusual example, or probably attorneys would be really good at this. Attorneys are really good at learning things just based on auditory. I am not. Not at all. I have to work it out on pencil and paper, and then I get it. Okay. So one more call. Let me know if there's any questions here, anything else that you want me to go over, or any other examples, or if something didn't make sense, I'll hang around here for a minute. Otherwise, seeing nothing. Okay. I'm going to hold out here just for another few seconds here just to see if there's any other questions. But otherwise, what I'd recommend that you guys do is just kind of go back through the examples here, and then it should make more sense to you. Yeah, I'd love to do that in an app. All right, guys, I tell you what, thanks for hanging out with me here today. I'm going to keep this one. I'm going to wrap it up here and keep this tight. Let me know if there's any other questions. You can hit me up on the Discord page, or through email, as always, support@ReadySetCrypto.com. All right. Thanks, everybody. And we'll probably see you tomorrow in Trade School for tomorrow. Adios, mañana.
There goes a sight from my soul.